SoFi and PayPal are two interesting financial technology companies that investors are asking me to compare and answer which one I think is a better investment at current market prices. I'll answer that question in this video in response to your question asking me to make that video. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the first things I like to do when comparing two companies is look at their revenue growth over recent years. And with PayPal and SoFi, I went back to 2017 looking at revenue growth in that time. PayPal increased its revenue from 13 billion to 32 billion. That's good for compounded annual growth of 13%. Meanwhile, SoFi increased its revenue from 500 million to 3 billion, and that's good for compounded growth rates of 27% in that time. Each of these companies has strong tailwinds pushing growth ahead. For PayPal, that tailwind is an increasing percentage of spending moving online. PayPal offers convenience advantages to people shopping online as it allows you to make purchases without taking out your credit card, putting in all that information, and then making a purchase. Whereas if you have a PayPal account and the merchant offers PayPal, you can click on Pay with PayPal and it goes through a lot more smoothly, a lot more easily. I can't tell you how many times I've followed the process to make a purchase, and then if the company doesn't have PayPal and then I realize my wallet's not in my pocket, I just don't make that purchase. So I skip that purchase altogether. A lot of times I never go back to purchase whatever it was I was looking at purchasing. But if they had PayPal available and all I had to do was just click PayPal to make a purchase, I would have made that purchase. And so that convenience advantage has allowed many transactions to go through for merchants, whereas otherwise they may not be. For SoFi, the company has made smart investments in its online digital services and bank. It wants to offer anything you need in your life financially. The company benefited by skipping the whole brick and mortar and going straight online, all digital, the app, the website, and that's working effectively, especially as competitors, brick and mortar competitors, have divested or underinvested in their brick and mortar locations. If those brick and mortar banks, I'm talking about Wells Fargo, Bank of America, Citibank, and JP Morgan Chase, if they have really leaned into their brick and mortar locations, that would be a very difficult barrier for SoFi to overcome because they have thousands of locations around the world, communities close to customers, established relationships. And they've kind of punted on that. They've just kind of said, you know what, we're going to put the minimum amount of investment in these locations, staffing them minimally, training the individuals in these banks minimally. And so when you go into these branches, you don't get all the service you're looking for. And more, you just stop going to these branches because what's the reason for going into these branches if they're not going to have a mortgage broker at the location so you can talk to about a home loan? I can't remember the last bank I went into that had a person there that you could talk to about getting a home loan, refinancing your home loan, maybe getting a home equity line of credit. That's all done online or over the phone. So again, why do you have a brick and mortar presence if you're not going to staff those locations to capitalize on that presence? Well, SoFi said, thank you. We'll take advantage of that. We'll go all online. So we'll compete against you online, but we're not weighed down by all of these brick and mortar branches that we have to maintain and pay for, and it weighs down our balance sheet. We don't have that. So that's been a strong advantage for SoFi. I expect that will continue. I don't see that trend reversing. I see that trend actually worsening as these legacy banks have invested more in technology, have leaned into their online and app and digital services, and have underinvested continuously in their brick and mortar locations. And I'm reading conference calls from these legacy banks, and I hear more of the same, trying to cut down on spending on individuals, trying to cut down on operating expenses, invest more in technology, invest more in artificial intelligence. And again, moving online, that benefits SoFi. The next thing I wanted to compare these two on is their returns on invested capital, and they're nearly identical, but SoFi has the better trend, and that's important. SoFi has improved its return on invested capital from negative 5.8% up to 7.2%, while PayPal has maintained its return on invested capital from 7.3 fluctuating but ending up at 7.2. Looking ahead, PayPal's business is likely to get a boost as more people spend more money online. Its business has been hurt since the economic reopening because if I were to look at consumer spending behavior as it stands over the previous 3 years, it's been unprecedented in terms of the percentage that people are spending on services versus the percentage people are spending on goods. It's been heavily weighted towards services compared to, let's say, 2019. And that's because in 2020, 2021, and 2022, when we were locked down at home, we couldn't spend on services. We couldn't go out to bars and restaurants and theme parks and ball games and travel, etc. So we spent a lot of money on laptops and computers and smartphones, etc. And so now, or I shouldn't say now, but when economies reopen, people made up for lost time in those categories like travel and concerts and theme parks and restaurants and bars. And they've continued that trend. It still hasn't normalized to 2019 levels of goods and services spending by consumers. And now, with the impacts of tariffs starting to trickle their way into the economy, that's likely to slow down that reversal because, relatively speaking, the cost of goods, the cost of things are going to increase because most of the things that are sold in the United States are imported from outside of the United States, and it's going to take a long time to change that. And so as consumers start to see these higher prices for things, and then they compare that with the prices for services, the relative attractiveness of services is going to remain, and it's going to cause that shift back to a more normalized behavior of spending on goods and services. It's going to take longer to normalize. That's going to be a headwind for PayPal looking ahead. So now that we looked at some of the performance metrics, let's look at valuation. SoFi stock, I calculated a fair value for this business at $18.93. The current market price is $28. SoFi stock has soared year to date in 2025. I had SoFi stock rated as a buy for most of the year, but after it was up about 85% in 2025, I told investors that I was downgrading SoFi stock to a hold because of the valuation, because the stock price had increased by so much already. PayPal, meanwhile, I calculated a fair value of 127. Current price is 68. PayPal stock looks meaningfully undervalued based on my proprietary DCF valuation. Furthermore, when I go back to fiscal.ai, which is my preferred data provider, you see the link in the description if you're interested in their service, you can see SoFi stock is trading at a forward price to earnings of 66, while PayPal is trading at a forward PE of 12.6. SoFi is more than 5 times as expensive as PayPal, according to this valuation metric. So both valuation metrics that I use to evaluate valuation point to SoFi stock being overvalued compared to PayPal. So if I had to pick between one of these two stocks to buy right now, I would pick PayPal. PayPal would be my choice for better stock to buy. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.